Learn to invest in the stock market from scratch. One step ahead of Wall Street. Who has not ever thought about investing in the stock market? The proliferation of stock news in the media and the promise of big profits continue to attract many small and medium investors. However, before launching into the world of the stock market, it is necessary to take into account a series of basic tips. A minority may have some form of financial training, but the vast majority are newbies, entering the world of active money management for the first time. Therefore, before placing the first purchase order, it is advisable to take into account a series of principles that can serve to avoid unpleasant experiences or repeat mistakes that other investors have already made. Step 1. How much money do I invest? Only the one you don't need. This is perhaps the most important rule of all, and it is the question that any investor should ask before even starting to learn about trading on the stock market. The market is not a rosy world, and it is more than possible to end up losing all the investment. We must be aware of this possibility and assume that it may happen, so we should never invest what we can or will need in case of an emergency. Step 2. What are my goals? You cannot enter the market to see them coming. You must be clear about what you want to achieve beyond the obvious answer: make money. It is about calculating the profitability you want to obtain, the term in which you want to achieve it, and the risk you are willing to assume. All three variables must be aligned, because you cannot expect a double-digit return, say 20%, without taking risks. Obviously, it has to be a reasonable goal and if possible to be numerical, that is, a percentage of the money invested. The important thing is to forget about the march of the markets and focus on making the money you have put into play profitable. Step 3. Should I invest for the long term? The term of the investment will be following your personality, but you must bear in mind that to operate in the short term, more knowledge and experience are necessary than to do it in the long term. In this sense, it is convenient to look at the long-term return. That is what should count when carrying out your operations. Thus, you must buy companies that fit that goal. If, for example, you have decided to obtain 10% in 2 years, you will have to look for titles that adapt to that premise. In addition, trading short will increase the number of commissions you have to face, and therefore your profit will be lower. Step 4. Learn to interpret the information. Information is power, and more so in the case of the stock market, where the specific value of each company is at stake. Thus, the market is full of news, reports, and all kinds of data about not only companies but also macroeconomic indicators, investor sentiments. It is vital to know how to interpret each of this information, and for this, there is usually no other choice but to read both annual accounts and bibliography to learn how to decipher an economic balance. Step number 5. Buy companies you know. You must invest in companies, not securities, and for this, you must have as much information as possible about the company. This implies both knowing the news that surrounds it and the sector in which it operates, as well as knowing how to interpret its financial situation and its business, that is, why it makes money and why it can continue to do so in the future. Here, obviously, you should also take into account aspects such as competition or the perspectives of the entire sector. This knowledge will allow you, for example, to buy stocks at a good price. It is necessary to emphasize that the price must be irrelevant for the investor. That is to say, it does not matter that the share costs €100 or €1. It matters the profitability that we think it will offer, because, in the end, the benefit will be the same. Generally, small investors tend to think that stocks above €50 have less growth potential and more risk because they need to raise more in euros for the percentage to be relevant. Those ideas have to be banished. As a rule, it will always be easier, and generally safer, to bet on large companies. In this sense, It can also be positive to start with companies with a good dividend policy, which would be a way of anticipating part of the revaluation that we have planned to obtain. Step number 6: diversify your investment. Being too imbued with a sector can lead you to want to invest excessively within it. One of the first premises that you should be clear about is the need to diversify your portfolio to minimize the risks you take on. It is relatively easy for a sector or company to suffer falls, but not for 3 or 4 different ones to do so at the same time. However, we must diversify as far as we can. If you can know 10 companies well, buy 10 companies, neither 9 nor 11. If you can know 20, buy 20. If you can know 5, buy 5. Normally, if you can know 20, you will end up with a portfolio made up of the 8 or 5 best investment opportunities. Step number 7: be wary of unique opportunities. In the stock market, no goose lays golden eggs. No investment ensures a spectacular return without having to run any type of risk. For this reason, when faced with proposals for large profits above the market, the first thing to do is to act with caution, not to believe anything they have told us, and to find out. In the same way, if in your analysis of a company you only see strengths, doubt your conclusion. These types of companies only exist in stories. There is also no magic formula to determine whether a value will go up or down. The PER, the dividend yield, other parameters of fundamental analysis, or the different systems of technical analysis are indicators about the action, not an oracle that tells us without margin of error when to buy or sell or the future of the security. Step number 8: follow your own strategy. This is one of the maxims of trading on the stock market. Thanks to the internet, there is a multitude of forums, specialized web pages, and blogs where information about values, possible bulls, is shared and different types of advice are given. To these, we must add the traditional media and the different financial analysts. The amount of recommendations and advice that you will find is infinite, and that is why you must bear in mind that it is always about opinions, more or less interested, more or less founded, but opinions. At the end of the day, the experts reach a series of conclusions through an analysis, fundamental or technical. It does not matter that it does not have to be better than the one you do yourself. That is, if your analysis tells you to buy, do not stop doing it because of the opinion of a certain expert. This does not mean that you have to constantly turn a deaf ear, but as none of the analysts has a crystal ball, they limit themselves to expressing their opinion, which may obviously be wrong. Step number 9: follow the trend, but not the mass. When the time has come to actually enter the market and start trading, it is advisable to invest in favor of the trend. Stock prices always move in trends, some easy and others more difficult to identify, which can last for years and which are advisable to follow. At this point, it is advisable to be patient before venturing to identify a change in trend. On the other hand, this does not mean that it is necessary to strictly follow the indications of the market in general, since it is also necessary to have a sufficiently critical and independent spirit to not get carried away by moments of panic or euphoria. In addition, if you manage to stay safe from the so-called market sentiment, it will be easier to identify investment opportunities precisely because of an excess or lack of sentiment. Step number 10: let the profits run and cut your losses. It is one of the great premises for any investor. Investors are more likely to sell when we win 10% than when we lose. In other words, it is difficult for us to bear the losses, and we tend to wait until the handicap is already too great. In this sense, it is necessary to be consistent with the objective set, especially about the deadline, and act accordingly. In any case, the first thing you should learn as an investor is to put a stop to your losses, that is, establish a so-called stop loss, or level of losses that you are willing to assume and from which you will automatically sell the shares. As you can see, following these rules is not always as easy as it sounds, because they require a good dose of patience. To begin with, one of the characteristics that every investor should have. In any case, if you are still not clear about investing under your own criteria, you can always leave your money in the hands of professional brokers or get cold in stock market games where the investment is not real. Of course, neither will the profits you obtain.